Hello student, welcome back to IBS. Let's jump to the topic limitation of income statement. There are a lot of limitations, so let's jump understand it one by one. Income statement provide valuable insight to company financial performance. This is talking about benefit, but it several limitations can affect the usefulness of prediction future cash flow. It will affect you for usefulness of predicting future cash flow. These limitations arise primarily due to periodic nature of income statement, which involve estimate and judgment. Here are the some limitations. First of all, estimate dependent net income, what they are trying to say. So their net income is based on estimate, based on their assumption, which can affect by reported performance for the period. So how come they are saying your income statement is based on estimate? This is not actual. This is what they are saying. What they are saying is correct. Why? Because we follow accrual method. Accrual method is not actual method, not cash basis method. Earlier all the company used to follow cash basis. That time actual net profit was coming, but that was again have issue. That I'm not going on that. But the point here is when you have not received invoices but you have consumed the expense, based on that we are booking the expense. Similarly for revenue, we have delivered the service and then we can allow to book the revenue. Likewise many other things like for bad debt, we are taking assumption and putting into the expense side, we are adding bad debt. Likewise also we have interest we have not received, based on contract and term and condition we can calculate what we are going to pay, because that is our obligation, we have to pay and this is belong to this particular period, so that interest we will book. For rental related stuff, if you have not received bill but still you know this expenses belong to this particular period, so you will book those kind of expenses. So these all are based on assumption. So that is what they are saying, your income statement is not actual, it's all assumption. So this is what they are trying to say. This is the biggest limitation, I would say, but there is no other option. We have to go ahead and take assumption and finalize our income statement because of the financial reporting standard kind of stuff. And another thing is we have to close our books of account, and we can't wait for actual. And also when you compare after 2 3 months, when you actually receive the invoices, okay, for all the invoices for whatever things we have taken accrual or we have taken any assumption or something, we can check. So this also giving us our historical information, how earlier we have done this and what was the result and what was the differences. Based on all this study what we have already conducted, so likewise we are able to make accurate assumption. We can predict more better how much would be our bad debt, how much would be our interest expense. So all these things will be most accurate. So almost 99% they are accurate, though it is based on assumption, but that is the option we have to create our income statement, and that will be considered as an accurate income statement. But still he is saying is also correct. Impact on accounting method, if different method can be used, so that impact can be in your figure. Like if you are using a depreciation method for particular asset, and if you change that method from SLM to double DB method, double depreciation method, double DM method, or from LIFO to FIFO or weighted average, if you are changing this kind of your accounting method, so that will obviously impact your amount. So that is what the point is. So this is also one of the limitation. Judgment and estimate already discussed, involve significant judgment. For instance, amount depreciation expense depend on the estimate of asset useful life. For example, you have purchased product or laptop, we think it will be having 3 years of life. Based on that we are splitting their entire cost into 36 different parts, and every month we are charging to that particular amount. So but after 3 years you can see that this asset is still usable, so we can further revalue that asset and created the asset value. And then we have also we have added 2 more year, and now we are dividing that fair value of asset by 24, and now we are calculating division, whatever it is. The point here is you have estimated 3 years of life, but it is going beyond that. For also for land or building you are depreciating, land you are not depreciating, or neither you are appreciating. So, but actually the land values keep on increasing. So these are the thing which is the limitation. Exclusion of unmeasurable item. Item cannot be reliably measured, are not included in the income statement. For example, brand recognition, very well said. Product quality improvement. These are the things like your employee effectiveness, your internal control, your policy, your ERP system effectiveness, automation, customization, finance related transformation, your FP&A. quality, your financial team, their ability to work and vote more effectively. These are the things we cannot mention in our income statement. Revenue and gain recognition. Revenue and gain are only recognized when they reliably measured and realizable. This means they are converted into cash or claimed to cash. Holding gain available for sales security through realizable are excluded. When you are having share and that is available for sale or as of particular 31st of December, their share value earlier we have purchased for 100, now his value is 150. We cannot book this into our revenue, or maybe after expense days then our operating profit has been incurred, whatever it is. Then after there is non-core business related item will be there, so there we cannot mention $50 as a gain because this is not realized. So this is what they are saying, that is still that is realizable. You think that it has increased, later on it will not go down, but still you cannot be able to mention in your income statement. So that is the drawback, because you are hiding the net profit. This is what the point here is. What we do to report, we mention in our other comprehensive income, that will be in your equity section of your balance sheet. Comprehensive income represent the total change in equity from all source of other than transaction with owner. It includes item not captured in net income, okay, which is very good, offering the broader view of economic performance. So that for removing the this kind of stuff which is we cannot mention in our income statement, like foreign currency translation, realizable security, those kind of stuff, fair value we can update and mention in our comprehensive income. The last point is note, comprehensive income provides more complete picture of financial performance, capturing the changes in QT not reflected in income. How we prepare income statement? In below income statement we prepare comprehensive income, then whatever the result will come, so that is what they are saying. Comprehensive income is called including both of them. This one you will say accumulated comprehensive income, and when we club together then we can say comprehensive income. So that is what it is saying, comprehensive income is giving more accurate figure. Okay, so we are done for the day. We'll see you into the next session. Thank you very much. Stay tuned.